Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. We've brought in Suresh Surana again this week because we got so many questions from you about your taxes. Suresh, thank you so much for joining us. Our first question comes in from Sheila. Now, Sheila works for a US-based company that buys products from India, and she's based in India right now, but the company doesn't have an office in India. What they do is that they transfer $1,400 every month into her account as her salary. Now, she's aware of the fact that the company is not deducting any tax, and she has to pay income tax in India because that is where she's working. She wants to know how she should go about paying tax, Suresh, and who she should pay the tax to. So obviously there's a process involved here. Suresh is going to take us through it. Suresh, what should she do?
Yeah, so Sheila, first of all, it is necessary for your employer to deduct tax at source from your salary income because as an employer, you are having taxable income and there is an obligation on your employer to deduct the tax which is applicable. So you should discuss with your employer and hopefully then they will look into this aspect. But even if your employer is not deducting the tax at source, then the obligation is on you to pay the applicable tax by way of advance tax or self-assessment tax, and you compute your income. You can claim the deductions, of course, under section 80C or any other section which is applicable, and on the balance income which is taxable, you pay the tax as per advance tax slabs which are applicable on 15 September, 15 December and 15th March. So that would help you to fulfill your obligations under the income tax law.
All right, our next question comes in from Jay Ramakrishnan, who has a similar problem. He works for an American-based company. He was allotted shares of that company under the employee stock ownership plan. Now, he tells us he wants to know if he needs to pay tax in India. His employer is already making deductions of 20% amount as tax in the States. He wants to know if he should also file this as part of his returns in the Form 16. Suresh, obviously, there is a very complicated treatment, unfortunately, of employee stock options in India. But what happens when those options are actually US-based? What should he do then?
Yes, Mr. Jha, you will have to offer this amount for taxation in India, and at the same time, you will be eligible to claim the credit for whatever your employer has deducted the tax. Just because the employer has deducted the tax, it does not mean that your reporting obligation is not there. You still need to report the salary income and compute the tax thereon and claim the credit for the tax deducted. So that's an obligation which is there, and you must file your return before the applicable due date.
All right, last question on the show. Monu Matthew has written in. Now, he's looking at selling property that he owns, and he's got a great deal of 65 lakh rupees as an offer for that property. He wants to know what he should do to avoid paying tax on that property. Suresh, 65 lakh rupees is what he's making. He hasn't told us what he bought the property at, which will actually determine whether it's long-term capital gains or short-term capital gains. Irrespective, what can he do to avoid paying tax?
So, in case you are selling the house property, you have two different options where you can claim the benefit. The first benefit is if you reinvest the capital gains in purchase of another residential property, then under section 54 of the Income Tax Act, you can claim the benefit of the exemption. For this purpose, you must purchase the new house within a period of 2 years from the date of sale, or 1 year prior to the date of sale, or alternatively, you must construct. In case you are constructing the house, then it must be constructed within the period of 3 years from the date of sale. In case your return is already due and you have not yet made the investment, then you can deposit the money in capital gains account scheme and use the money from capital gains account scheme for the purpose of purchase or construction of new house. The second option is under section 54 EC, up to rupees 50 lakh you can make investment in capital gains bonds, which are the NABARD bonds or National Highway Authority of India bonds, and that much amount will be then exempted. However, this will be subject to the lock-in period of 3 years, and therefore you need to consider that if you want to really purchase the house, then you must deposit in capital gains account scheme or make the investment before the due date of your return.
All right, Suresh, thank you so much for answering those questions. Now, if you have a question about tax, write to us. Suresh will answer your questions for you, and we'll try and help you in every possible way. In the meantime, two very important announcements I want to remind you about. One is we want to know if you've been watching the show and you found it helpful. Record a quick video on your cell phone and email it to us, Email ID is on your screen right now. Secondly, Budget Day will be on the 10th of July. We'll have a special show like we always do in this studio on the 10th of July between 7 and 8 o'clock in the evening that will explain to you what the budget means for your money. You can, of course, watch the show, and if you'd like to come into the studio, be part of our audience and ask your questions, also write to us on the same email ID or reach me on Twitter. We'll get in touch with you and tell you how you can be part of that show. Thanks for watching Investor's Guide. Stay with ET now.